After 2 years of higher interest rates, there could be good news ahead for some investors. There's strong speculation of North American banks possibly cutting interest rates in 2024, which helps to stimulate the economy by making borrowing cheaper and encouraging more spending versus saving. Although performance is never guaranteed, the resulting shifts can create timely investing opportunities in the equity and fixed income markets. First, existing bondholders can potentially profit. Existing bond prices and their yields have an inverse relationship with rate cuts. When central banks cut rates, prices of existing bonds generally rise, hence why current holders may be able to sell theirs at a profit. This is because the interest rate on those bonds, called the coupon rate, may not be attainable with newly issued bonds. So they're more attractive, resulting in a price increase. Lower yields mean less interest in fixed income products, such as new bonds, GICs, and bank savings accounts. So investors may turn to the equity market to try and earn higher returns within their level of risk tolerance. Next, growth investors may see greater opportunities. Although many growth stocks typically benefit from rate cuts, small cap stocks can experience even greater gains. Being in their early growth stages, small caps often have more debt than large companies, hence why they can benefit more from cheaper borrowing. Data between 1970 and 2023 shows that small caps outperformed large caps 76% of the time in the 12 months after rates were cut and earnings increased. Finally, cyclical stocks also tend to grow. Cheaper borrowing particularly benefits cyclical industries, namely real estate, finance, technology, and consumer discretionary, as they also rely heavily on consumer loans to generate higher revenue. History even shows that since 1970, cyclical stocks commonly outperform the markets in the first 12 months of cuts. Rate announcements happen 8 times yearly in Canada and in the US, so they can be a good cue to review and revise your assets to keep your long-term goals on track. For a deeper dive, hit the link below.